I'm Roger Montgomery from Montgomery Investment Management, and welcome to this week's Video Insight. Well, the four horsemen of the apocalypse described in the last book of the Bible's New Testament seems like an extreme metaphor to commence talking about one possible scenario for Australian investors. But complacency is everywhere, and it's worth asking whether a financial crisis in the next few years is possible and what investors can do to protect themselves. According to Carmen, Reinhart and Kenneth Rogoff, authors of the New York Times bestseller This Time is Different, 8 Centuries of Financial Folly, the history of financial crises reveal a standard and repeating set of 4 leading indicators. These are asset price inflation, particularly real estate, rising household leverage, outsized borrowings from abroad and reflected in a sequence of gaping current account and trade deficits, and slowing economic output. It does look like Australia scores 4 from 4 when considering these factors. And if you believe after 25 years of uninterrupted growth, a modern and sophisticated Western economy like Australia's is immune to a financial banking crisis, remember the last one had its epicentre in the United States, where that country's conceit about its financial and regulatory system's robustness arguably laid the foundations for the GFC. So let's quickly run through the 4 horsemen of a financial crisis. Number 1 is surging asset prices. Bubble-like conditions in the Australian property market now exist. Crowded auction and apartment releases where investors care nothing about the enjoyment of the property, the income it generates, or even its long-run worth, and care only about whether it will go up next week or next month, as it did last week and last month, is the precise ingredient for a bubble first described by John Kenneth Galbraith in his book The Great Crash, which was published in 1954. As this chart shows, comparing house price to income, Australian real estate is some of the most expensive in the world. But as this second chart, going back to the 1960s, reveals, supply is also at a record. Construction of apartments has recently risen astronomically and well in excess of that required by Australia's 1.6% annual population growth. Record prices and oversupply cannot coexist for very long. It didn't in iron ore, and it won't in commodity-like homogeneous apartments. Of course, deniers are also required for bubble conditions to occur. They ensure the behaviour that leads to a crash continues. One 39-year-old Melbourne developer, who was featured in the Australian Financial Review BRW's Young Rich list for 2016, admitted there was a supply issue but observed, and I quote, "If you're doing projects in the 30 to 60 apartment range, you're going to be okay. It's the 200 plus mark that's going to be harder." End quote. Melbourne developers believe the problem lies in Sydney and Brisbane, while Sydney developers believe the issues lie only in Brisbane and Melbourne. Denying there is a problem continues the behaviour that produces the problem. When real estate agents start asking developers for 100% of their marketing commissions to be paid upfront into a trust account, which we're hearing is now occurring, you know those who believe they are immune to the issues that only exist elsewhere are simply wrong. They'll all be sucked into the vortex together. Let's now look at horseman number 2, debt. At the same time that house prices are rising stratospherically, debt is being accumulated at an alarming rate. There is always, and without exception, one common theme to the vast number of crises the world has experienced: excessive debt accumulation, irrespective of whether it is by the government, banks, businesses, or consumers. And the accumulation of debt almost always poses greater systemic risks than it seems during the boom, making banks, for example, seem far more stable and profitable than they really are, while the injection of cash makes the growth that results look more sustainable than it really is. As this chart of household debt to GDP shows, Australia's debt levels are at an historic record. And as this chart shows from the OECD, household debt to income is now sitting at 206%, one of the highest levels in the world, and up from 56% in 1990 and 125% in 2002. According to the Bank of International Settlements study in 2005, when housing booms are accompanied by sharp rises in debt, the risk of crisis is significantly elevated. This final debt-related chart reveals private credit card usage is also rising spectacularly. Quite simply, Australians have taken on more debt, typically to chase more expensive houses, and have less money to pay for it all. If you're sanguine towards the levels of private debt, you should be alarmed by the rapid increase in government debt that can occur when economic conditions begin to slow. In a recent column in the Australian Financial Review, Julie Ann Sprague penned a fascinating insight into Perth's economic downturn and what is being described by some there as the worst in 40 years, with 500 people leaving WA each month, according to Bankwest chief economist Alan Langford, and geologists with 10 years experience now having to drive for Uber. Residents on the east coast of Australia wouldn't know there's a problem, but like beachgoers unaware of an impending tsunami hurtling towards them, all of Australia might eventually be engulfed in something far worse than leveraged property speculators in Sydney and Melbourne and Brisbane would like to believe. When Colin Barnett's government came to office in 2008, WA's net debt sat at just $3.6 billion. In just 8 years, that figure has grown to $27 billion and is forecast to reach $40 billion by 2019. From the 19 post-war bank-centred crises studied by Reinhart and Rogoff, they conclude that markedly rising asset prices, slowing real economic activity, large current account deficits and sustained debt accumulation are important precursors to a financial crisis. Let's look at Horseman number 3, expanding current account deficits. In the United States, prior to the subprime crisis, US Fed Chair Alan Greenspan branded as alarmists those who worried excessively about the burgeoning US current account deficit, which reached 6.5% of GDP. As can be seen in this chart, in 2015, Australia recorded a current account deficit of 4.6% of the country's gross domestic product, compared to an average of 3.24% since 1960. Investors should remember, however, that current account deficits simply mean revenue from our exports are insufficient to meet the cost of our imports. The gap needs to be funded by borrowings or the sale of assets, neither of which makes for a solid balance sheet. Let's look finally at Horseman number 4, slowing economic growth. This is the final ingredient that precedes a financial crisis, a slowing economy. Globally, the International Monetary Fund has just cut its forecast for global growth, warning that a precarious outlook amid rising protectionism and a lack of commitment to economic reform could bring further growth forecast downgrades next year. As WA is now demonstrating that Australia is not immune to the impact of a slowing world or a slowing major trade partner. The east coast of our country appears to be blissfully unaware of WA's tribulations, and yet apartment oversupply will eventually cause the residential construction boom to end. If the industry lays off just 20% of their workforce, a workforce that employs 12% of the total in Australia, the impact on growth will produce the fourth and final ingredient that has historically preceded every crisis since World War II. So what should you do? Well, we can't forecast with certainty what will happen next, and we can't accurately forecast where asset prices will go. We also know that in the long run, we will make much more money being invested in businesses than being in bonds or cash or property at these prices. Investors are well served when they listen to Mark Twain, who said, "When you find yourself on the side of the majority, it's time to pause and reflect." Today, cash is the least attractive asset class, and the majority are running a mile from it, pouring their money into property and high-priced, large-cap, low-growth stocks that offer attractive yields. We think this is dangerous. Investors should be looking to do 3 things. Number 1, reduce their weighting to the most expensive infrastructure and utility companies. Why, for example, should Sydney Airports and Auckland International Airport be the 2 most expensive listed airports in the world on an EV to EBITDA basis? Speaking geographically, they're located on a vacant block at the end of a global cul-de-sac. You should also be reducing your weightings to large cap and index funds, which are weighted to companies paying the majority of their earnings out as a dividend, but guaranteeing no growth thanks to very high dividend payout ratios. Number two, the first step will raise cash, which is the least popular asset class. But it may in fact be a very smart place to be because cash is most valuable when no one else has any. And it represents an option over lower asset prices in the future. And three, take a look at less traditional funds, such as long, short and market neutral funds. They've always been seen as alternatives. Perhaps now though, with asset prices elevated thanks to 30 years of declining interest rates, it might just be the time they should be considered mainstream. And I'll add one more thing to our list. Invest with managers that focus on growth. If and when interest rates eventually rise, the P in the PE ratio will have to fall. And the only way to offset that is if the E in the PE ratio, earnings, grows significantly. You need growth to offset rising interest rates. Well, that's all we've got time for today. We look forward to seeing you next week here at the blog, and please keep following us on Facebook and Twitter.